Something? Oh, there we go.
There it is.
All right. Perfect. We're live. Yay.
Yay. All right. So here we are. We made it to June 5th. Jessica Luganville with Porchlight Real Estate, and I'm here with Matt Powell from Leader One.
Thank you for having me, Jessica. Appreciate
Yep.
it very much.
Happy to have you here, Matt. So we're just going to dive right in today, Matt. I'm going to just give a little background about what I've been up to the last 3 weeks, which would bring us to the questions I want to talk to you about specifically.
For sure.
So what I've seen in my business is a huge increase in first-time home buyers. And I think there's a couple of reasons for that. One, these are people who already knew they wanted to buy a house. And so they were just waiting for lockdown to end.
Yeah.
So there's that group. And then I also have first-time home buyers who actually weren't going to buy a house this year, but then through the process of some, whatever, self-evaluation or, hey, we only live once, or why are we waiting? What are we waiting for? They've decided to buy a house. So I've just seen this influx of first-time home buyers, which I know is true across the marketplace based on what we're seeing in the up to $500,000 price range is just wild. Like 23 offers, 19 offers. So it's just been an interesting time. So I'm sure you're seeing the same thing as far as your new loan apps increasing for first-time home buyers.
Yeah.
Yeah.
Yep.
So one of the questions I get a lot, and I know you get a lot, I thought it would be good to just address here and maybe start those thought process running for people who are on the fence. It's kind of the difference in different loan programs, specifically between FHA and conventional. I have a lot of first-time home buyers who really could do either. And so talking about the difference in what is an FHA loan versus what is a conventional, and if you can share some of that, I have some specific questions, but if you want to jump into your thoughts.
Yeah. So first, to elaborate on yours, there's a lot of studies that are going on right now and numbers that are coming out that there's a lot of rentees, leases that are not going, have basically told they're not going to renew leases. They want to, through all this stuff, they want a place of their own. They want to be able to keep it clean, how they, whatever their insecurities are with renting. Now they want to move, which is great for us, right? It's a great opportunity. But yeah, so going to your question here, conventional and FHA, there are a lot of people who can qualify for each. A lot of people get to a certain point from a credit standpoint to where a conventional loan is better, right? Because conventional loans are more heavily graded on credit score when it involves kind of what rate you're getting and what mortgage insurance you're paying. So if you have a first-time home buyer who's maybe in the market to put 3 to 5% down, depending, that can come on either conventional or FHA. Can come from a number of different sources. It could come from gift funds. It could come from bonus from work. It could come from nonprofit organizations. There's a lot of different places it can come from. And so at some point, definitely for the lower end credit score, FHA is typically better because the mortgage insurance, the amount of mortgage insurance that's on a loan or that's required for the loan doesn't change whether you're an 800 credit score or a 600 credit score. Okay, those are all the same. All right, your rate might change, your interest rate, but not the amount of coverage that you have on your mortgage insurance, which translates to cost, right? More monthly payment. Whereas conventional, at some point when you get above a 680, 700, conventional kind of surpasses FHA, and because you've got maybe a young professional, got a great credit score, or right mid 700s, 3% down conventional option or 5% down conventional option is probably going to be much better than an FHA option. Really, because at some point the mortgage insurance does get cheaper on those. Also, FHA, that some people should know, FHA is life of the loan mortgage insurance, meaning I get into an FHA loan, that mortgage insurance stays for all 30 years. Now, some people take that too far because getting an FHA loan is usually the first step of a two-step process that I like to call it, right? If somebody needs to get into a home or has the desire to get into a home, maybe they use an FHA loan as their first step, and then they follow it up in a 12 months, a year, 12 months, 18 months, 2 years down the road, and they're trying to get themselves into a more sensible, cost-effective conventional loan. So They can be used. They have kind of their intricacies that we kind of FHA will allow for a little bit higher debt to income ratio. Conventional is a little bit lower. Rates similar. Again, rates are more dependent on credit score across the board. But yeah, to say the main difference is once you get in the higher credit score, then typically conventional loan is better. Now, there's also some property standards that go along with this as well that we've got to be cognizant of. And FHA loans have health and safety standards. So railings, broken windows, tripping hazards, stuff like that have to be rectified on the property. And so you're familiar with that. Most listing agents will go in and say, kind of do their own analysis and say, hey, we can list this property with FHA, VA, conventional financing, or nope, we've got too much stuff here that may be tripped by an FHA appraiser. And that is strictly up to the appraiser at their discretion. So peeling paint is another one that's common that we see. So, but yeah, they're both great. They conventional and FHA and even VA if we have any veterans that are hopping on this, but they're all great first-time homebuyer programs. First-time homebuyer, the term first-time homebuyer is kind of a marketing tag right now. There's certain down payment assistance programs that require you to be a first-time homebuyer, but unfortunately, that whole first-time homebuyer thing, again, it's just a marketing kind of make the phone ring.
Yeah, I just had a conversation with someone yesterday about that because she's a second-time home buyer, and she's like, "I wish I could be a first-time home buyer." And I said, "That's not really what you wish."
Really, not getting much better of a deal or changing much. So,
no.
Like I said, yeah, there used to be 10, 15 years ago, you used to have rates for first-time home buyers. So
it was a kind of a benefit to be a first-time home buyer.
Yep.
Can we back up a little bit? Because the idea of PMI or mortgage insurance, especially for a first-time home buyer, is such an abstract concept. Can you just talk about what that actually is? Who's being insured, who's paying for it, and what it is?
So one, the borrower is always paying for it, whoever's buying the home. Mortgage insurance is there to reduce the risk or mitigate the risk on the lender, us. So to protect us from default. So whether it's an FHA loan or a conventional loan with less than 20% down, all on one loan balance now. But if it's either of those and you don't have 20% into it, then you're going to have mortgage insurance. On FHA, you have mortgage insurance across the board. Or if you put 50% down, but it wouldn't make sense to do. But the mortgage insurance is there to again protect the lender, to protect the investor from loss, from default, from foreclosure. If that were to happen, the lender could use that insurance policy to protect a certain amount of that loan. So there on the FHA loan, there's both upfront mortgage insurance that you finance into your loan. It's included into your loan amount or added to your loan amount. And there's monthly on that as well. So you have FHA that has monthly and upfront. And then conventional has a lot of different options. And this is where I kind of really like to dive in with clients, because conventional, you can have monthly mortgage insurance. You can have upfront where you pay just a one-time upfront premium. So say, for instance, somebody's getting some seller concessions possibly, or maybe they've got a little bit extra money saved up and they want to cheapen their payment, they can buy out that mortgage insurance right up front. So they can pay a one-time fee at closing, and then they don't have monthly. So it makes their monthly payment a little bit more sensible. There's also upfront financed, where if they're putting, say, 5% down, they can finance the upfront fee and, again, make their monthly payment more sensible. And then last but not least, there's split premium MI, where you pay an upfront and a reduced monthly amount. So a lot of different options. Again, some of those better FICO borrowers have a lot more options to them. But it's a tool that can be used, especially now with great rates. You can jump into that kind of forever loan right away, where you're buying out your mortgage insurance up front, and then you got that really low rate. So you really never have to touch that loan for as long as you can imagine, So
I think the bottom line is it's not black and white, right? Like you always want conventional, you always want FHA. And I think the other really important message to relay is you might be able to buy a house and you're sitting there thinking you can't.
Yes.
You have to have 20% down. That's a myth. You don't have to have a 700 credit score. That's a myth. There's a lot of programs that are available and a lot of workarounds. I mean, lenders are problem solvers, and so are real estate agents.
Yep.
And so I just encourage people who say, "Oh, I'm renting. I need to wait until this happens." Somewhere along the line, they read an article that said, "I have to have 20% down, or I have to do this." And I just encourage them to give us a call and say, "What are my options here?" Because with rates being what they are, you can afford more house, is how we phrase it, right?
Yeah. Yep, correct. And think of it this way too: is a lot of people who are scared to purchase a home or just don't know, right? It may not be scared; they just don't know all the options that are available. You've given yourself a raise, to tell you the truth. One, I know that I have tools that I can show people. I'm sure you do. The cost of waiting, and that's really the biggest thing that hinders people. Is think about this: our area here locally has seen 15 at the least percent appreciation over the last 2 years. And think of that difference. If you're talking right on a $300,000 home, you're talking $45,000 in value over the last 2 years. Well, what's happened now if you wait another 2 years? I'm not saying that it's going to be 15%, but real estate overall appreciates. And so that cost of waiting, while their rents are going up too, now their future is just getting more and more unattainable, right? And quite often I run into people where you're renting and you're paying the same amount, especially with rates are where they are now, as you can buy. And guess what? You get tax benefits. So you're giving yourself a raise. You actually can go back after about a year of owning a home and maybe meeting with a CPA and saying, "Hey, how can I give myself a raise from my monthly paycheck where now I know I have that mortgage interest deduction right later on in the year?" So there's a lot of ways that you can make it attainable. And again, buying real estate is the best investment you can ever make. So it's not throwing your money away like renting. You're
Right.
always going to need a place to live. Why not rent from yourself, so to speak?
I got a question here that popped up from Tyler. I'm actually going to put it on the screen so that we can see it.
Okay.
Here's the question. If you buy out your PMI, which we were just talking about, is there a refund option when the house reaches its 80% value? Great question, Tyler.
That is a great question. There are a ton of different options on how the MI works on conventional. On government, right, you can't buy that out. But on conventional, there are a ton of different options as far as when it renews and how it renews and so forth. The basic rule for buying out your mortgage insurance or having mortgage insurance on a conventional loan is you have to keep it there until you get to that roughly 20% equity or 2 years, right? So say you do a monthly premium and in 2 years, Jessica's come back to you with a CMA on your house or something and says, "Hey, Tyler, I really think you got close to that 20% equity in your home." You can then approach the mortgage insurance company without refinancing. They have a process that you go through and say, "Hey, I'd like to remove this." And they might do an appraisal. They might have comps submitted. There's a process that you go through, but it saves you the refinance costs later on. So that's kind of the general rule of thumb. But yeah, there are options for refundable PMI and so forth. Typically what happens is, as you can imagine, if you choose the refundable option, well, then it's probably a little bit more upfront, right? Because
so you have to talk about on the front end. So Tyler's about to close on a house in, about 6 weeks.
Okay.
And so Tyler, if you want to know if you're buying out your PMI and you want to know if it's refundable, we're going to have to ask that question, right? And get the number if you want it to be refundable.
First find out what you're doing, is if you're doing the upfront or financed, because those are the two refundable options, right? You pay it as a fee, a flat fee, like a underwriting fee or any other fee associated with the loan, or if you're financing it into the loan, meaning you're adding that to your loan balance, and that's going to cost you over the time because you're paying interest all the time. So find out what you got or what your lender has kind of allocated you for, because there's a lot of different options, and there's a lot of different mortgage insurance companies, primarily about 5 or 6 that most big lenders use that are out there.
New build. He's doing a new build. So
yeah, so just double check. And if you've got any questions or would like me to even just read over paperwork, get a hold of me through Jessica and we can take a look at it.
Thanks. Awesome, Matt. So Tyler, if we didn't answer your question or you have another one, pop it back up. I'm going to take this one off of here. If I can figure out how to do that. Oh, here it is.
Good work.
Yeah. The other thing I'd like to talk a little bit about and how it impacts me as the agent negotiating, trying to win the deal when we have, I mean, we just won a deal where there were 12 offers on a house, which is not uncommon. It's not even like raising an eyebrow anymore, in Westminster. And we actually won it out. We weren't the highest offer. And we knew that going in, but we were a conventional loan, non-contingent. And so you touched on the idea of property standards with FHA. And I think people often hear a seller would rather, all things being equal, right? A seller would rather see a conventional loan than an FHA loan. And that's true. And I think a part of that is because of that property standard piece. You want to talk about that at all?
Yeah. So all things equal, right? If you've got a good lender and they've done their due diligence and they've got them through underwriting and they're confident in their approval, really a loan isn't any different, right? We don't close, when we get people under contract, we don't close less of a percentage of conventional than, or FHA compared to conventional. But yes, usually agents are worried about the appraisal, right? They kind of have this, and through big companies, they use different appraisers for different types, whether it's conventional, FHA. Our appraisers here at Leader One are all the same. So we have a roster of appraisers, and they just do all of our appraisals except for VA. But they'll do them all the same with the same standards or whatnot. But you're dealing with the same people. But you can get yourself a little less competitive with FHA just because of those property standards. They're worried about an appraiser coming through and finding some peeling paint that nobody noticed, or maybe there's a small set of steps, like 3 steps, and it's more than 2 feet off the ground of a deck and it doesn't have a railing or something like that. And that peeling paint could be, it doesn't have to be on the house. It could be on the shed. It could be on structure, right? It could be on playgrounds. It could be, I mean, there's a lot of different things. So yeah, they are. Typically what I tell people is the more due diligence you can do on the client up front, which we try and do, is getting them through underwriting up front. We can usually help win out those offers just with kind of some proactive stuff that we do. Calling the listing agent, taking the initiative to talk to them, taking the initiative to answer their questions. And right now, we're even with some of our clients who might be in that competitive arena in terms of offers. We're asking them up front, hey, if I call this listing agent and Jessica's going to go put an offer in for us, do I have your permission to release some info? Because right now you've got, and if they're comfortable, and then I'll explain why and say, hey guys, here's the deal. If we're going to be competitive, right, we've got to put our cards on the table a little bit here. And so I might say, hey, do you mind if I tell them how much you got in the bank? Do you mind if I tell them kind of where your credit score range is? Do you mind if I tell them, how long you've been on the job, right? Those are normal stuff that we're not supposed to release, but I will ask them and tell them why and say, hey, here's the deal. We've got to make them feel warm and fuzzy from your competitive offer standpoint, but we've also got to make them feel warm and fuzzy from me as a lender standpoint, because we're the one approving a loan. So they want to make sure we get to the closing table. And that's a great touch on your point, right? You're not always the highest and best. And that doesn't mean that you're not the best, right? Because again, somebody can come in and offer 20 grand over, put an appraisal gap in there, and their lender could have taken their application 20 minutes before. So, yeah, exactly. Online, no docs, all that sort of stuff. So you've got to do your due diligence. There's a lot of different stuff that we do here at Leader One that's just standard practice that really puts us above and beyond when we're going and reaching out for our buyers.
I'm so glad you brought that up, and I think it's a good closing point. In this competitive market, the best thing that you can do for yourself as a buyer is have a real estate agent who's relationship based. I always call the listing agent and ask the questions like, what are the most important things for the buyer? It's not always about price, right? Yep. Sometimes there's
very rarely
they want to close. Sometimes there's just a lot of things. So a relationship-based real estate agent and then a relationship-based lender goes a long way on those phone calls and creating trust and ensuring we're going to have a great deal with communication. So I'm so glad you brought that up. And I think it's, you don't even have a great agent, but if they're not making the calls on your behalf and they're not building those relationships, it's going to be that much harder to get your deal accepted in this market.
Correct. And I'll touch real quick on that. I don't want to, waste a ton of time on it, but one of my biggest questions that I ask when I'm working with, say, with a buyer with Jessica or whoever is, who's the listing agent on that other property, right? Do we know them? Do we have a relationship? Have we worked together in the past? Do we just close one? Because again, like you said, the relationship based, local, and somebody that you can walk into their office if you have to, right? You don't want to, but they've got to be local. They've got to have a pulse on your market. They've got to, again, like you said, relationship based. And I think that's huge, because that can't happen on a loan officer from Quicken who sits at a desk in Missouri. So that kind of stuff is just right. You've got to have that. And that's why we're here. We're very high touch, high value, and so forth. So we want to make sure that people get to the closing table.
I think that's a great way to end this conversation.
Yeah, thank you.
Thanks for being here, Matt. I'll talk to Tyler later if he has more questions, or if anyone else has more questions that are loan questions and I don't know how to answer. I will send them your way.
I appreciate it. Thank you very much.
Thanks.
Have a wonderful week. Yep. Bye-bye.